Great trades take far more than a good setup or strategy. At our firm, we use a 5-step process to ensure we consistently put on one good trade. And in this video, you'll learn all 5 steps in detail. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn so you can grow your trading account.
I'd like to take a minute to talk through the 5 steps that I use to place a trade. The 5 steps that I use to place any trade, whether it's a scalp or move to move or trade to hold or swing trade. There are really 5 things that I think are kind of the standard that you have to do. And we'll use this as an example of them. So, the first one is the catalyst. So what has been the prevailing catalyst as of late?
Interest rates.
Inflation, rates, more specifically rates, right? We go back to TLT. That has been the prevailing theme. When you start to see things on financial entertainment networks, which is a term we use for CNBC and stuff like that, they're really not financial advice, they're financial entertainment, right? When you start to see comments about rates and equities and how bad the higher interest rates are for equities and stuff like that, that is the prevailing theme. That has been the prevailing theme. That's what led us lower starting, 15 days ago or 10 days ago, 12 days ago, I guess now. We had those concerns about higher rates, right? Higher for longer being a big concern. So that has been the prevailing catalyst, right? Up until about 2 days ago, that led to, or 3 days ago really, that led to a lot of ability to short pops because there was aggressive selling. There's really good selling across the market broadly, right? And then we even kind of closed lows on Friday. And what's the other catalyst that we've had that kind of has been overshadowing the market, but I would argue that it hasn't really been that negative for us?
The war.
The war, yeah. Like surprisingly, it hasn't been that negative, right? So, you have 2 catalysts that I would argue the primary driver of all this has been rates, right? Higher interest rates, particularly on the short end of the yield curve, has been a big concern for the market and big concern for equity. So that's the base case here.
Maybe because they have many members mentioned that maybe some rate hikes are not longer necessary.
Correct. That was yesterday. But even a couple days before, what have we seen if we go back to look at TLT in particular? Where did it put in its low? Ackman covered his short, right? So Ackman covered his short in TLT. It was a great short. It was a great trade that he had on. He tweeted out that he covered his short. He doesn't believe that it's a valuable, that the risk reward is in his favor any more than it already was, right? So that's telling you that somebody who's had a really good trade on is saying, the risk reward isn't really great for me in this trade. So that was a few days ago, and the market kind of continued a little bit lower from there, right? So that was the first clue that this catalyst might be shifting. And that was 1 vote by 1 player, right? Then we started to see what? We had that move down on Friday, but then coming in, what happened to Monday?
Yeah, we gapped up on Monday.
We gapped up in the market. Wednesday, we had what data point?
Was that ADP payrolls?
Yeah, and what percentage was that payrolls beat, for lack of a better term? Yeah, it was more than 10%, which is our threshold. It was actually closer to 20%. That's a big beat, right? That's a huge narrative shift that really started a couple days before. That catalyst lost its importance based on that catalyst a couple days before, based on TLT being weak or bond, the yields increasing, basically. That catalyst started shifting a few days ago. And then we had a data point yesterday. That was a big data point. And then we had FOMC yesterday afternoon. What did the FOMC rate members say? The committee say? -10 is as hawkish as they could be. +10 is as dovish as they could be. Where did they score?
Let's say +7.
Yes, +7. I would agree with that. No one came out and said, we're probably going to be cutting rates right away. but they didn't say that they were going to be raising, and they also said that it's probably not likely that they will need to raise, right? Or at least enough members said that.
Correct. And I think how I noted that in my DRC is that it was a reaction to the lack of hawkishness.
Correct. That is the appropriate way to look at this. It's a reaction to the lack of follow through. That's how catalysts typically shift. Is the catalyst was TLT is going to go lower. And then you had one vote for TLT not going lower. And rates were going to go higher. And so that was going to be bad for equities, right? Then you had one vote with Ackman. Then you had another vote with a huge beat on, 20% beat on the jobs number, which is a big thing, right? And then you had another vote with the FOMC rate committee, right? So you have now 3 votes against. So all of a sudden, this shift in this narrative has occurred, right? We've gone from a negative shift to a positive shift in this catalyst, right? It's not like it's positive 10 all of a sudden and everything's okay, but that's a big shift in the way that we would score that catalyst, right? Particularly with those 3 important events. Okay, now, so you have this shift in the catalyst that really cemented itself at 2 o'clock yesterday afternoon. Let's talk specifically about the setup, which is the second component of any really trade that you should make on our desk. What was the setup coming into yesterday after the jobs number?
Range breakout, or maybe fail to break out of the range.
Yeah, it was a failed breakdown, right? It was truly a failed breakdown. If you look at this entire range, you can see how important that yellow line on our chart was. You can see it on the daily down on the bottom left. You can see it on the hourly there, and then you can see it on the 15-minute, and then even more importantly, you can see it intraday yesterday. Where were we holding above? Or right around?
420?
Yeah, that's a 9 out of 10 level, right? It's a 9 out of 10 because it was resistance. On the far left of our daily chart, it was resistance. Then it turned into a breakout. Then it turned into support, right? And then it turned into support again. We would expect it to act as resistance the first time we were up there. And did this market act like that was resistance yesterday?
No.
Not at all, right? This is not the way something responds to a 9 out of 10 resistance level. A 9 out of 10 resistance level, you touch it and you go away from it quickly. We just touched it, went a little higher, and then sat there. That's not the way you respond to a 9 out of 10 resistance level. So that all of a sudden meant that the sellers were not there anymore. They weren't respecting that level. They weren't pressing against that level. So the setup changed. It was a failed breakdown below that range. What's our measured move for this target based on that failed breakdown below that 420 level? 430. Why? So you take the 420, and then where was the low?
409, 410.
410, right? So you have 10 points, and then you add it to the upside. That puts you at 430. Where are we trading?
Well, we got
Yeah,
to
let's
the
put
high,
that at
429.
429, right? So very, very simply, this is the sort of thing that you're looking for out of this setup. We don't know how quickly it's going to get there, but when you have a failed breakdown of range, you target the height of the range for one measured move, right? You're not necessarily risking to the low end of the range because we haven't had a trade yet. We're just setting the stage for this trade, right? So then that's 2 components of the 5 components for a trade on our desk. The third component, so we have catalyst set. We had that shift in the catalyst, in the score of the catalyst that mattered. Then we had the setup, right? We have a failed breakdown, and we have a target accordingly. Now you actually have to have a trade. It's not enough to just put that on and say, okay, here I'm going to go. Now you actually have to have a trade, right? So what trade did we have here? You had a range break to the upside, right? A trending day trade, basically, right? Like one of the things that you can do in a trending day is take the range break to the upside into the close. We had that, right? And this is not something we do a ton of on our desk, but this is a situation where it is 100% appropriate to use very short dated options where you are using upside premium, because the expectation is that by the end of the week, we will go to 430 based on the catalyst and that shift, based on the setup and that shift. Then we have a trade, and we have a very simple trade, which is a range break to the upside, right? You put on that trade with short dated options, ideally Friday, and you look for, even if we wouldn't have gotten a gap today, actually a gap down would have been even better, because then you could have a different trade, right? Say a small gap down right into the support level. Well, all of a sudden I'd be looking for a down through open, right? With like continuation to the upside. I'd be looking for, today even, we had a range break to the upside in the market, right? If you zoom into just the price action today. So even if you didn't catch any of the gap, we had a very nice range that got built out. The range was above the open, and you can take a range break to the upside trade targeting that 430-ish area, right? We have a catalyst. We have a setup. We have a trade. You could express it in this name. You could express it in a lot of other names, but those are the first three components. The fourth component is trade strategy. So your trade is range break trade to the upside, but that's incomplete if we go back to the price action from yesterday. That's incomplete to just say, I'm taking a range break trade to the upside without identifying where you're risking, how you're risking it, and what you're actually trying to do out of that, right? So we kind of glossed over the trade strategy a bit. We're going to take a step back and look at it. The trade strategy on a range break trade to the upside, and really every trade should have a trade strategy, right? The trade strategy in this case was, you either, if you're using equities, your risk is to the low of the range. That's a typical range break stop, right? And if you're using options, your risk is to those options going to zero. You are legitimately risking with those going to zero, right? And that's okay. There are situations when it's worth it to do that. Your trade strategy will include your actual entry trigger for the trade. It will include your risk point in the trade. It will include likely the price action that you're looking for, or the multiple ways that that trade can play out to show you that trade is doing exactly what it's doing. That third component adds a little bit of dynamic risk adjustment to the trade. So if you put on this trade and it gaps down to support, right? But it doesn't stop you out. What are you almost immediately looking for to know that that trade's likely to work? Say we would have gapped down to 420 today. Would that mean my trade is invalid? No. But wouldn't I look for almost an immediate response of buyers stepping in? If I know exactly what's going on, I actually have a trade strategy. The first four components, that catalyst, setup, trade strategy, that's what we call a trading business. When you have those four components, you actually have a trading business. So catalyst, setup, trade, and trade strategy are a trading business. How do you evaluate if that trading business makes money consistently? Well, that's our fifth component to any good trade. You review it. You can start to review using TraderView or Excel or handwriting it in a notebook. There are other programs you can use out there as well. But you start to review, first of all, the probabilities of that trade and how well it works and the times that that trade is more likely to work. And then more importantly, your execution of that trade against the trade strategy. So that's why it's difficult to evaluate how well you're trading unless you actually know what the trade strategy is. Because if you're unsure what the trade strategy is, the trade strategy, again, is your entry rules, your stop rules, your kind of dynamic rules of what's increasing the probability of this trade, what's decreasing the probability of this trade, and then your kind of expectations for the trade a little bit based on your experience. Without that, you don't really have a trade strategy. The good thing is it's pretty easy to come up with a trade strategy if you understand the reason for that trade existing. If you understand the reason for that shift, in this case, that occurred, and that shift is what caused this trade to drop into our laps for us. The shift in the catalyst, the shift in the setup, that caused this trade opportunity to come in. So what are our expectations? That essentially buyers are going to have to chase. Shorts are going to be wrong and buyers are going to have to chase. So we expect a relatively aggressive move. That's why we can say if we gap down even kind of right back to support, we have that expectation that it would work almost right away, right? So that's why that trade strategy is important. But then the review is so important because once you have that catalyst, setup, trade strategy, then you can review a trade. And your review at the end of the month, or really ideally after you get 20 of these examples, and we're using a big, broad market-based example on a swing trade. But the reality is you could have that same exact catalyst shift, setup, shift, range break trade occurring on an intraday basis. You could have it occurring on a 1-minute chart. You could have it occurring on a 15-minute chart. These same things will happen over and over and over. The focus shouldn't be only on swing trades, but that same catalyst, setup, trade strategy can occur on almost any time frame. You just want to understand that so intensely so that when you come to review, you're going to be looking through your results and saying, is this trading business a profitable trading business for me? If it's a profitable trading business for you, that's where you get to talk about dynamic risk adjustment. You get to talk about, hey, if I get 3 extra higher probability indications that this trade is going to work, I'm going to scale it up. If I get 2 saying it's not likely to work, I'm going to actually cut it back and put on half risk. That 5-step process may seem really complex, but if you just start doing it, you're going to find that it's actually relatively simple. And in the simplicity of it is actually what makes it so beautiful and what makes it so powerful.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.